You have $100, not a windfall, not a bonus, not money from an inheritance, just $100, the amount that disappears in a weekend without you even noticing where it went. Most people look at $100 and think, that's not enough to change anything. What's the point? I've spent 30 years in finance watching people make that exact assumption, and I've watched it cost them everything. Because here's what most people never find out. $100 a month, invested consistently, becomes something that will genuinely shock you. Not in a get-rich-quick way. In a, this is how wealth actually works way. Stay with me, because by the end of this video, you're going to see the full numbers. And the numbers are going to change how you think about every $100 you have from this point forward. Part 1. The assumption that keeps people broke. Let me tell you what I hear most often from people who haven't started investing yet. I'll start when I have more money. 100 isn't enough to make a difference. I'll wait until things settle down. I understand why people think that way. $100 feels small against the size of the problem. Retirement, financial freedom, building real wealth, those feel like big numbers. And $100 feels like a rounding error. But here's what that thinking gets wrong. Wealth is never built in one large move. It's built in small, consistent decisions, repeated over a long enough period of time, until the math takes over and does the heavy lifting for you. The investor waiting for a larger amount to start almost never starts. Because the larger amount arrives, and life finds a way to absorb it. The investor who starts with $100 today builds something the waiting investor never will. Not because $100 is magic, because starting is. Part 2. What $100 actually becomes. Let me show you the real numbers. And I want you to pay attention here, because this is the part most people never sit down and actually calculate. You invest $100 every single month. You put it into a simple index fund tracking the broad stock market, which has historically returned around 10% annually on average. Year 1, you've contributed $1,200. Your account reads roughly $1,312. $112 in returns. Not impressive yet. Year 5, you've put in $6,000. Your balance sits at around $8,200. The gap between what you contributed and what you have is starting to widen. Year 10, $12,000 contributed. Balance, approximately $20,500. You now have $8,500 more than you ever deposited. The market is contributing alongside you. Year 20, $24,000 contributed. Balance, approximately $76,000. You have $52,000 more than you put in, more than double your total investment. Generated without a second job, without a windfall, without doing anything except not stopping. Year 30, $36,000 contributed. Balance, approximately $227,000. Year 40, $48,000 contributed. Balance, $637,000. You invested $48,000 across 40 years. The remaining $589,000, you never deposited it. You never earned it at a job. You never won it. Time built it. Compounding built it. And the decision to start with $100 instead of waiting for the perfect moment, that built it. Part 3. Why compounding feels slow until it doesn't. Here's the part nobody warns you about. The first few years feel like nothing is happening. Year 1, $112 in returns. Year 2, you're barely above what you contributed. The account doesn't feel like it's working. It feels like a jar you're slowly filling. Most people quietly stop here, not with a dramatic decision to quit, just a month where the transfer doesn't happen. Then another month, then a year passes, and the habit is gone. I've seen this pattern more times than I can count in 30 years of watching people and money. The ones who stop in year 2 are the ones who retire wondering why the financial freedom they planned for never arrived. The ones who stayed, who kept feeding the machine through the boring early years, discovered something in year 10 that changes everything. The returns stop feeling like a bonus. They start feeling like a second contributor. Someone else putting money into your account every single month alongside you. That someone is time. And time never misses a contribution, never panics, never sells at the bottom, never asks for a day off. In year 1, the market returned you $112. In year 10, roughly $1,700 in a single year. In year 20, approximately $7,000 in 1 year. In year 30, around $22,700 annually. From $100 a month, the machine you built with pocket change eventually generates more in a single year than most people save in 5. Part 4. What about market crashes? I know what some of you are thinking right now. Dave, what happens when the market drops? What happens to my $100 then? Good question, and an honest one. The market will drop. It always does. I've lived through crashes that scared even the most experienced investors on Wall Street. 2001, the dot-com crash. 2008, the global financial crisis. 2020, the COVID collapse. Each time, red numbers everywhere. Each time, people panicking, selling, waiting for it to feel safe again. Here's what 30 years taught me about those moments. When the market drops, your $100 buys more shares than it did before. You are buying the same investments at a discount. The investor who kept contributing through every crash didn't just survive those periods. They quietly bought more of the market at the lowest prices it would ever be again. And when the recovery came, and it always came, those discounted shares multiplied. The crash isn't the danger. The danger is the investor who stops at the crash. Who breaks the consistency? Who turns a temporary drop into a permanent exit? Stay consistent. The market has recovered from every single downturn in recorded history. Everyone. Part 5. The identity shift. Here's the part of this story that doesn't show up in any spreadsheet. Something changes in you when you invest consistently over time. Your relationship with money shifts. You stop reacting to every headline. You stop checking your balance out of anxiety and start checking it out of curiosity. You understand, in a way that feels real and personal, not just theoretical, that time is working for you. And your conversations about money change. When someone tells you they're waiting for the right time to start, you don't lecture them. You remember what waiting felt like. And you say something quiet and true, because you know something they don't yet. The right time was yesterday. The second best time is today. And every month spent waiting is a month compounding isn't working. Let me bring this home. $100 a month. $48,000 contributed over 40 years. $637,000 waiting at the end. $589,000. That time built for you while you lived your life. You don't need a windfall. You don't need a high income. You don't need a perfect plan or a financial advisor or a complicated strategy. You need $100. You need consistency. And you need to start today instead of waiting for tomorrow to feel more like the right time. Because here's the truth I've watched play out across 30 years and thousands of people. The ones who built real wealth weren't smarter than everyone else. They weren't luckier. They just started. And they didn't stop. That's it. That's the whole formula. If this video showed you something today, subscribe to the channel. Because every week we're going deeper. Real numbers, real strategies, real financial education from someone who has spent 30 years watching what actually works. And drop a comment below. What's stopping you from starting today? I read every single one. I'm Dave. This is Finance with Dave. Let's talk money. The real way.